A company can be measured by different variables like revenue and cash on hand, goodwill, reputation, its marketplace, and different things. A company also has asset valuations and ROI, which is return on investment. It's basically the way the managers use the assets and the available cash to generate a profit every year. When you think about a company the way Warren Buffett does, you want to see a castle that's very strong and a moat around that castle so no one can approach it. A great example of this is Coke. Coke has been around, has a huge, long history, an unbelievably great reputation, a wonderful product. The moat is basically the competitors can't come near it. They can't get the formula. It's very secret. It's not well known. People love it all around the world, and it has huge distribution all around the world too. This is a perfect example of Warren Buffett stock. It's one of the premier stocks in the world. Warren Buffett also puts his money where his mouth is and owns tons of it, and is actually on the board, or was on the board of Coke. When you first look into a stock, you want to find out which sector you want to invest in, and whether you want materials or industrials or different ones listed here. People from the 70s and 80s remember the Pepsi challenges, where Coke and Pepsi were put up against each other, and basically Pepsi always pretended like it won, but what it would do is make Coke, the nasty hot Coke with no ice, and Pepsi would have ice next to it and be sugary sweet. So many people went for Pepsi at that point. But the point is that you want to find out what is the best of breed. When you compare two products, I'm just saying Pepsi and Coke, but it could be anything, whether it's gasoline or materials or industrial mining. You want to compare all the different companies and find out which is the best. Generally, the ones that are billion-dollar companies are labeled in the best category, but you want the best of all of the best. You don't want to mess around with number 2 or number 3 or the up-and-comer. Yes, you'll make more money, but it's also really, really risky. I would not advise that. Here we go to financeyahoo.com, and we type in VAIL, which is our ticker symbol. So we chose 3 stocks to evaluate: VAIL, Ambev, and Netflix. So we're going to analyze them according to their fundamentals. We're going to use open source tools, which are like Yahoo Finance. We're going to go to the profile. We're going to find out where it's actually located. It's Rio de Janeiro in Brazil. So it's basic materials, other mining, metals and mining. So that's the industry. That's also the sector. So now we're going to go to summary. First we look at the price. It's $11.24. And we look at the PE ratio. That's very high. It's extremely high. That's way beyond what is normal. So we already put in the price in the spreadsheet. This is a spreadsheet that I made up to analyze the 3 stocks. Then we have a 6.11 dividend. However, as you'll see, that you've got to be careful that just because you see that on a spreadsheet doesn't mean that it's automatically correct. So we'll find out in a little bit what I'm talking about. So the earnings per share is 12 cents a share, which is extremely low. The price is okay, but now we're looking at the price history. You can tell that it's a little high, but compared to the absolute max, it's medium but moderate. But in reality, it's a little high. But for that earnings per share, it's very high. So now we're going to look at conversations. What are people saying about this? It's also called scuttlebutt. They see that they're talking about the different earnings. You know, the news about earnings. They're restoring the dividend. Obviously, they've lost the dividend. So what's going on there? So that 6.11 is incorrect. Does anyone know what happened to the dividend that was declared last year but never paid? So basically you're on stock, you're not going to get dividends. So that's a red on the conversations, no doubt. So it also makes the dividend, even though normally that would be great, but if it keeps if they don't pay out the dividend, then it's a zero. So it means the company's in trouble. Now we're going to look at the different news items that Yahoo has. And of course, you should supplement these with other sources of information. So this is definitely not a buy. So the thing about stocks is it's a process of elimination. So, of course, you could look at 20 stocks and that'd be fine too. But you pick a sector and then you decide you're going to go after it. And I'm giving you 3 example ones. And I've already done the legwork for you, so I wouldn't have to make this a 20-minute video. But I filled in all the gaps here on Ambev and Netflix and Vail. And Netflix has a horrible price. PE is extremely high. Just basically Netflix is not a buy at all. The only one left is Ambev. So what we're going to do is we've got past level 1 of looking at. Now we're going to go into level 2. We're going to look at the debt. So in order to get to that, you need to go to the liabilities portion right here. You can see the debt. You got the equity of the stockholders, and you always want the debt's okay. It's not unbelievably great. It's not extremely high, but at the same time, 0 would be perfect. But we'll just call it a moderate. Now, expert opinion is something that you should take with a grain of salt. Experts, if they really knew what they were doing, they'd be rich and they wouldn't be doing it. So that tells you something. But you can get an idea. They say that it's overvalued. That's in the red zone. So we're going to say red. But the thing is that you don't take that variable too seriously. It's more important what you think, not what the experts think. Now you can dig deeper on this, how many analysts there are and what their estimates of the EPS per year, what the future cast is, that sort of thing. So the more analysts you have, generally the better the opinions, but there's a lot of bias and prejudice in these numbers, so don't take them as the gospel truth. So now we're going to look at return on equity. We're getting into Warren Buffett area right here, because we're looking on return on net assets. Basically, how effectively is management using a company's assets to create profits? And return on equity measures how effectively management is using a company's assets to create profits. Whether an ROE is considered satisfactory is dependent on the normal industry ROE for its peers. You can so anything less than 10. Well, right here it shows the actual equation. So there's actually a place in Yahoo you can find it. You don't have to calculate yourself. You can, and that's perfectly fine. And there's nothing wrong with double checking, because I've found errors when you check. Yahoo is not perfect, and no place should be used solely. But what you're trying to do, like I said, is trying to eliminate stocks, not find stocks. And when you finally find the best stocks that you've, with all the green and mostly green and maybe a few yellows, then you compare all those. So you just want to look at how the industry does according to its peers. If it's got a steady ROE of 18% over last year compared to the other ones, which are 15%, so it would be, you don't want something a high flyer. If it's way too high, there's probably something wrong. There's probably something wrong with the data or the reporting or something, or it could be a one-time issue. Now, if it has too much debt, it's going to hurt ROE. And the thing is, the numbers can be juiced. So ROE is a very great number. It's not as good as PE. PE is actually more important than the PPS, the price per share, because you can I could look at a price per share and it doesn't tell me very much, but a PE tells me a lot. But ROE is also an extremely important number. So we're going to go to statistics. Excuse me. Now we're going to look at the different things. This is the ROE. Notice that's 13.44%, and that's a good number. So it's a strong number. So you could always do some more analysis. The more information you get, the better. Now, moat is an extremely hard thing to analyze in a few moments, in a few minutes. Basically, a good example of a moat is Coca-Cola. Coca-Cola is best in breed. It has no one that compares to it. You know, the only ones that are close are Pepsi and the knockoff brands, but Pepsi is Pepsi. Not trying to offend Pepsi drinkers, but Coke is Coke, and Pepsi is Pepsi. And Coke doesn't have to imitate Pepsi. But you know, some of the store brands do try to imitate Coke, but it doesn't work. So now we're looking at total cash. Now what you want to look at is different years you have in front of you. You want to see it increasing, and obviously it is increasing. It's year over year. It went from 7 million to 10 million to 11 million to 14 million. So this is good. That's a good cash position. Now, granted, if it's a low amount of cash, even if it's increasing is great. But you know, Ambev has a good cash position. Now, what we're going to look at is level 3. We've moved past level 1 and 2, which usually eliminates probably 80% of the stocks. So we're looking at a decent stock here so far. So you know, it does have some yellow, but you know, you can't have a green. Well, it's rare when you find green on everything. What you're looking at now is the insider trading. So insiders are people who own the stock from within the company, like CEOs, financial officers, and people who are granted stock. Are they selling? Are they buying? Are they holding? And some of this is in this actual. I could not find it in Yahoo right away. I can find the institutional holders. You would probably have to go to their site and look at their company PDFs and brochures, like I mentioned, to drill down to find the actual the amount, or look at their SEC filings, which granted will take you a while. This will take you a couple hours to look. But basically, you're trying to find out whether the Ambev, are they buying, selling, or holding, the insiders. Now the institutions also, you could also put another column where are the institutions holding. Now we do know that the institutions have a lot of shares. The reason why I'm putting green here is because the holding, it's basically for the institutions, because I couldn't find the insider trading, insider holdings at all. So it was NA, but that's okay. It's out there. It's just not on Yahoo right at the moment for this one stock. Now all the SEC filings, the company PDFs, the 10K if it's applicable, and your overall feeling. And don't negate your gut. Your gut tells you what's right and what's wrong. If you have a bad feeling about it, walk away. There's tons, just like they say with you know, girlfriend, boyfriend, spouse. There's tons of fish out in the sea, and there's tons of stocks out there. So there's always, don't ever get into a stock and fall in love with it to the point where you'll buy it, regardless of what the analysis is. So in the short term, stocks are a popularity contest, like a beauty contest. In the long term, it's a weighing machine, and that's a very popular quote from back in the day. But basically, a weighing machine, the real true value of a stock will be known over time. What over time may be over 20 years, maybe 30 years. So now we're looking at the actual different things. There's all these variables here, and this is an abbreviation guide. So MRQ, most recent quarter, TTM, trailing 12 months, excuse me. YOY, year over year, LFY, last fiscal year. So due diligence is what you have to do before you buy. So it's on you to buy, to do your all your research before you buy. If you do it afterwards, you might have a problem, because you might have bought a dog stock or something. And I love dogs, but that doesn't matter. So basically, you look at the company numbers, see what you treat a company as if it's basically you're analyzing it like scientifically. So what you want to do is find out, looking at due diligence, what the actual revenue, profit, margin trends. It's not just where the company is now. It's not just in the past. You know, as they say with the rear view mirror, you know, it's always 2020. The problem is that where is the company going? And like a famous hockey player said, it's not where the puck is now, it's where the puck's going to be that I'm concerned with. And that's where you should be. You should want to know, where is this company now? I mean, at one time it was a great idea to probably invest in a horse and buggy company. But the moment that Ford Motor Company came along and cars started doing well, then that was probably not the stock to be in. And even the best of breed of the horse and buggy companies would be one to sell and move into a newer stock like Ford or Chevrolet or something like that. If you liked what you see, hit the subscribe button or share. Thank you. This has been EmersusTech.